Hi, this is James Jeng with Full Capital, and today we are here with Nick.Fluellen of Fluellen Hoover Multifamily, and we are going to be discussing Serena Vista, a new listing that recently came out. Nick, I'm going to kick it over to you, and why don't you tell us a little bit about the deal?
Great. Well, yeah, thanks, James. This is a deal that we're really excited about. We love a lot of things about this deal, but as you can see here, Serena Vista is in North Arlington, and it's 120 units. It's a great looking physical asset, and probably more importantly for everybody listening, the economics I think are extremely appealing on this deal. As you can see here, pretty centralized location just south of I-30, right in between Dallas and Fort Worth. Um, One of the things we love about this particular asset and this particular pocket is that the North Arlington submarket is the #1 submarket in all of DFW per RealPage for effective rent growth in 2019. It's also #1 as you look forward into the next few years, 2020, 2021, 2022. This is an absolutely premier submarket. Projected rent growth is almost 6% over the course of the next 2 years out here. So not numbers that you hear and see very often, but obviously it's a great place to be. Zooming in a little bit more into this Arlington area, for those who are not as familiar with this particular pocket, you've got all to the right of your screen here. You see it's where the Cowboys Stadium is, AT&T Stadium, Globe Life Park, where the Rangers play, Six Flags, which is a major attraction in the Metroplex. And then also the new stadium is right across the street to the south of Globe Life Park. And that whole area, the Texas Live development over there is spectacular. So this is really a strategic spot to be in. And I know, there's various people who feel like, hey, maybe we're going to flatten out a little and have a little bit of a downturn. This is the kind of area you want to be in if there is a downturn, because this is just a really attractive area to be. So quick aerial of the property shows just kind of what's on each side of it. At the top left of your screen, those are just single family homes. At the bottom right of your screen, those are single family homes. These are very, very nice homes. This neighborhood in Arlington is known as Interlochen, and these are $500,000 to $1 million+ homes. To the top right of your screen, that's kind of a senior rehab facility. And then the lower left of your screen is just a vacant lot. So this is really on an island, but what you do have surrounding it is really nice stuff, and these are quiet neighbors. The other thing I would tell you that you can't really tell on this aerial, but one of the things I love about this asset is there's a lot of topography and character on this site. And you can go to the next slide. You can see it a little bit more here, but in fact, the property is on a street called San Francisco Court. Obviously, because of whoever named this back when it was developed, it feels a little bit like San Francisco with the up and down nature of the property. So as far as amenities out here, while this is only 120 units, you have a really nice amenity package, which I think is really appealing to prospective renters. You can see a really beautiful swimming pool area. And then over to the left, there's a great common area for residents, for kids. They do barbecues and picnics and movie night, and there's a little amphitheater there that's all concrete seating out there. So it's just a really nice, charming common area just outside of the leasing office. You also have a dog park over there, so it's certainly a pet-friendly community. And then as you go in the leasing office, which you have 24-hour access to about half the leasing office, you have a state-of-the-art fitness center with some really nice equipment. And then there's a closed care laundry facility in there with 2 washers and 2 dryers that residents can access. During business hours, there's also a business center in the leasing office. So great amenities, more than you would expect for 120 units, and amenities that are really, really well done. Here's representative photos of the interiors of this asset. This finish out that you see in these photos is pretty typical of the vast majority of the property. In fact, all but 24 units really look like this at this point. And so when I say look like this, that laminate flooring, new appliances, They've generally replaced the cabinet doors in the kitchens and the fixtures and the faucets, and two-tone paint. Just really nice, good, clean units. The vast majority of these have washer dryer hookups. All but 15 units on the property have washer dryer hookups. We'll talk about that a little bit more in a moment. And in some of the newer upgrades, they're actually doing stainless appliances. So when you click on the information to access this deal on our website, we have a spreadsheet in there that goes unit by unit that shows exactly what every unit has had done to it. So appliances, AC, cabinet doors, etc. So it's really nice. I wish I had that on every deal. I don't, but on this deal, you could see exactly what's been done unit by unit. Great shape. So a couple of points on just the property details that I would love to highlight. Number one, the roof was completely replaced in 2015, and so it's in great shape. The parking lot also is in great condition, and so two major things that you don't have to worry about. This asset is traded a few times over the years. I happened to talk to one of the contractors who did some work out here, one of the previous trades, and all of the retaining walls out here used to be railroad ties. Those have all been replaced with stone too. So again, these are big ticket items that somebody never has to worry about in their holding period, which is nice. Individual HVACs and also individual hot water heaters, which is a big bonus instead of having boilers. Now, in the middle column here, you see trash and alarm monitoring circled. We'll talk a little bit more about this in a moment, but I would just note this is part of what I consider the upside story to be on this. Currently, residents don't have the choice, but they have to pay $25 a month for valet trash. And they also have to pay $25 a month to have a monitored security alarm in their unit. I think the current ownership feels like these are kind of nice amenities. But from a broker standpoint and just a pure investment metric standpoint, it's $50 out of the resident's pocket each month that you're really not making a whole lot of profit on. That's also unusual. I don't think you have to have either of these things to compete. In fact, I don't know any of the other competition that does have either of these things. So definitely some upside there. From a personnel standpoint, 120 units is, can be a challenging size of property to manage. They have 4 full-time employees here. Their payroll is extremely high, and I think there's an immediate upside there as well to get that down. So we'll speak a little bit more about that as we segue into what the upside story is here. This is page 6 in our offering memorandum, and if you understand this page, I think you really understand the gist of the deal here. And so I want to just walk through each of these items and just touch on them briefly. So while I think you see a property like this that's been so extensively upgraded, you say, well, I want more upside. And so I'd rather do the work myself, which is a common thing and not a wrong line of thinking. However, this submarket has been so vibrant that the current owner is doing really well, and he's been able to increase the revenues significantly since he bought the deal and has owned the deal. But he is still substantially below market rent, and we'll look at the rent comps briefly in a moment. But if anybody has questions about this after, I'd love to have a conversation. But there are comps that I consider very comparable or even inferior that are anywhere from $100 to $150 higher as is right now without doing anything. So normally if I can have a conversation with someone and say, hey, if you come in and do a $4,000 or $5,000 a unit upgrade, you can get $100 to $150 premium, they'd be excited about it. They should be more excited about this deal because the work's already been done and you still can get that premium. So that is not accounted for in that chart right there, and it's partially accounted for in our underwriting. We took a conservative approach to it, and again, we'll come to that in a moment. But just know there is massive rental upside here, as is right now if you did nothing else on the property. So that's number one. The upgrade program, which they are still actively doing. I mentioned earlier there's only 24 units that have not been upgraded. When we published this, there was 26. Any classic unit that comes available, they go ahead and upgrade it. And so while their market rents are under market, they're still getting about $100 delta between the upgraded and the non-upgraded units. So that's a no-brainer. Just continuing to turn those units as they come available is a significant upside opportunity. Expense reduction we talked about briefly. Payroll is really high on this deal. People love that because they feel like that's an immediate thing that they can change day one. The contract services are very high on this deal. Again, I feel like that's something you can change day one. Also, their landscaping, which is part of contract services, I think is a little on the high side. Their admin costs are a little on the high side. You might be able to shop the insurance a little bit. So there's a number of areas, but I can tell you they're running the deal for close to $6,800 a door. Should probably be at least $1,000 less than that, based on kind of what we typically see in the market. And I like that upside because that's day one upside. Getting into some specifics, they have 80 stackable washer and dryer connections on this property. As most of you know, people generally don't own a stackable washer and dryer. So in these type of assets, what we generally see is people go ahead and furnish all stackable units or all stackable connections with stackable washers and dryers. So I think there's a pretty immediate opportunity to go in and buy those washers and dryers and start leasing them. We modeled $35 a month. That's definitely on the low side. A lot of times we see as $50 a month. We modeled it at 35. It makes great sense at 35. If you can get more, it's just more upside. But the current owner's philosophy, I don't want to say philosophy, just attitudes, he didn't want to be in the washer and dryer business. And so he would just assume not mess with that. But I do think that's a great opportunity for somebody moving forward. Reserve parking. Our general rule of thumb is about a third of the property should be reserve parking. The car is the most valuable thing that just about all of these residents own, and they'd like to be able to park close to their unit and be able to keep an eye on their car. They have 25 reserve parking spaces currently. They lease those at $25 a month. There's 240 spaces on the property, so we assumed that another 55 spaces could be leased. That would bring the total to 80, which is 1/3 of that, and that would give you a nice quick income boost. And again, that's something you can probably be implemented within a few months. And then lastly, they haven't done any toilets out there. Their water bill's not astronomically high, but they haven't done any toilets or anything out there. So there may be an opportunity to get the water bill down even a little bit further. But that is, those are all just really good opportunities. And again, the thing I would note is what this does not factor in this chart when it says 1.4 million in value creation, it doesn't factor in that the rents are 100 to 150 lower just organically without doing a thing. So going to the rent comps, I'm not going to get into all of these, but the theme here is that there's a number of properties that are getting significantly higher rents than we are. And I don't think any of these properties are superior to our property. And so I think everybody that I've spoken with that's gone and shopped these properties feels like there's a tremendous opportunity to boost rents here. So that's definitely a takeaway. I'm happy to talk more specifically. Everybody who tours this property, I generally give them a little homework to go shop and drive a couple of these deals that I think will give them a pretty good flavor for the upside potential. As you can see in our model, the current market rents are $952 at the bottom of the middle column there. If you took the average of the 15 floor plans, our pro forma projections are 1033. Again, I think 100 to 150 is 100 is conservative. 150 I think is probably a little more in line with where you could be. We only modeled a little more than 75. So I feel like our model is very, very realistic, very conservative, and very doable. And again, the good thing from a prospective buyer standpoint is all this information is very quantifiable. Just looking at our current and pro forma, a couple of things I would note on our rental income. I think we really still have a higher than market vacancy and credit loss based on how this submarket is generally performing. So that's an opportunity, and you'd probably be even a little less than that number. On the other income side, you notice there's about a 20% increase there. That is just us phasing in some of the initiatives we talked about on the previous page. And that's phasing them in at about 55% here. If you looked out to year 3 in our model, you're going to see that number is going to grow a little bit more. So we just phased in some of these things just over time, and but it's a substantial amount of money. On the income or the expense side, rather, you notice that we did lower the R&M cost or the contract services costs, and we did lower the payroll expense. And again, those are I think that payroll number could be less than what we modeled. I think the contract services could be less than what we modeled there as well. Admin costs are down a little bit. Insurance costs are down a little bit in our pro forma as well. So there's a lot of opportunity here to get these numbers down. Expenses down even more than what we modeled, and the income up even more than what we modeled. The net effect of what we consider our pretty conservative underwriting is you see about a 76% increase in NOI. You can go look at the last 50 packages we've done, and you're not going to see a lot of 76% increases in NOI. I think our underwriting is known as being very realistic. And so that's why we're so excited about this deal, is that there is a great roadmap that is, just using data that's available to us that could get somebody there. So whether you get there in year one or it takes you a couple years, the bottom line is there's massive, massive potential here.
So before we jump into the debt side, Nick, I guess, can you give us sort of, I guess the deal could be priced two ways. Can you give us a little bit of flavor on sort of what the whisper price on the deal is, sort of looking at new debt versus existing debt?
Yeah, sure. We've been out for a couple weeks now. It's we've done a number of property tours. We'd love to keep getting people out there, and I think this is a deal where, by the way, people need to come see it, because all of this stuff kind of comes alive, and it's not just on a piece of paper, but you can really see it and feel it when you get out to the property. As an assumption, whisper price is somewhere in the mid $11 million range. There's been a lot of activity, so I would say mid $11 million range is a fair whisper price. The prepayment penalty, I want to say, is around $800, a little over $800,000 on this particular deal. So somebody wanted to put new financing, whether that be and I'll let you talk about that in a moment, but whether that be an agency loan or a bridge loan to sort of start implementing some of these things, you'd have to be probably $800,000 higher than whatever your assumption price would be. Now, a couple of comments on the assumption. The interest rate's very attractive. It's in the 4.21 range. There's still a couple of years of IO left by the time this deal closes, and there is a supplemental available. So it's a good loan in the way of an assumption. It's a good loan. The leverage is going to be a little lower than maybe what we would like to see, but again, somebody could buy the deal, do these things, and then come back in and even do a second supplemental after they've got some of the stuff on paper and a little bit more of a track record with that NOI growth that we talked about. But James, maybe you can comment on the new debt and the possibility of agency versus bridge.
Right. So let's just say on the new debt side, we're going to start at $12.5 million on the purchase price, and so Fannie is going to give you some of the credit on the expense reduction because they can see that sort of year one. And so payroll, they're going to bring down, I mean, we used $1,000 a door on our analysis here. Repairs and maintenance, we brought down to $500 a door. Majority of the other expenses are in line. And so, our overall expense load was about $650 to $675 on expenses. The thing that Fannie is not going to give you credit for really is all the upside on rents. And so they're going to look at a T3 on net rental, and then also a T12 on other income. And so when you do that, you get sort of halfway from where the current owner is on his NOI to where Fannie's going to underwrite it. And so on a Fannie loan, we're looking at about $8.3 million. And on that purchase price of 12.5, you're going to get 5 years interest only on a Fannie loan. And so an interesting thing to consider on this one is a bridge loan for because of the upside. If you needed to get more leverage on the deal, let's say 12.5 purchase price plus, let's say $500,000 in rehab, you're looking at $13 million all in. If you assume 75% loan to cost, you're right at about $10 million. And then if you go up to 80% loan to cost, it'll be about $10.4 million. And so we've got some bridge loan quotes anywhere from 75 to 80% loan to cost on a 3-year loan term. So those are your options. If you have the equity ready to go and you're okay putting a little bit more equity down, you can do a new Fannie quote, or if you need a little bit more leverage, a bridge loan is available. So flip over. Did you have
Yeah, I was
something?
going to say what I like about the possibility of a bridge loan is that you implement implement this business plan, and you have an opportunity to completely cash out your equity on a refi potentially. Whether you sell or refi, I feel like there's enough NOI growth possibility here where somebody could be in this deal in 2 years with all their money out and have a really nice asset.
Yeah, I mean, let's call it 12 and a half to 13 million all in, and then you go get a $10 million loan. You might be in for 3 million, and then you might be able to increase the value to 15, 16 million on exit and be able to refi or sell at that point. So on the loan assumption we talked about, so the current loan is right at about 5.7, I believe. And then if you add on 5.7, 5.8 with 4.21% interest rate, and has 2 years left to maturity. And if you add this supplemental loan, you can get essentially up to $8 million on the deal.
Correct.
And
that's right. A blended rate would be about 4.37. So it's in the way of an assumption, it's a pretty good loan. But again, you have an LTV issue, so it's definitely something you need to have a good plan for.
Okay, sorry about that. I misspoke. It's 6.8 million on the current loan, and then you add the supplemental 1.2, and that gets you to 8 million total loan proceeds. Underwriting is going to be similar, but it is going to be a little bit lower leverage because on a supplemental they're going to need a 130 debt service coverage. And so overall, you can decide to do the supplemental now, or you can wait and do it a little later once you have raised the NOI. And so those are sort of your three options: new debt Fannie, new debt bridge, or potential assumption supplemental. And so, Nick, is there a call for offers date yet set on this one, or are
No, I think we're going to send something out this week. It's likely to be May 14th.
Okay. All right. Perfect. Thanks a lot, Nick.
Yeah. Thank you, James.